Hello and welcome to Chapter 8, Variable Costing. So our learning objectives from this lesson is to distinguish between variable costing and absorption costing methods. We will be preparing income statement using the variable costing as well as absorption costing method. We will then reconcile the operating income under both of these methods and explain the pros and cons of variable costing as well as absorption costing. So your absorption costing versus your variable costing. The whole premise of this chapter is what to do with your fixed manufacturing overhead. Now, if you think about your manufacturing overhead from our earlier discussions, we discussed this in chapter 5 in length. So your manufacturing overhead necessarily is made up of some cost items that are variable, the other cost items that are fixed. So this chapter discusses how that fixed manufacturing overhead should be dealt with. How should we account for that? What should we do with that? So there are two alternative ways of looking at it. One is the absorption costing method. The other one is variable costing method, which is also called as direct or marginal costing. So under the variable costing method, they will only treat the variable cost as the manufacturing cost, which is truly variable. Okay, now variable cost, guys, is something that is completely avoidable. At zero production, your total variable cost is a zero. Okay, so these guys believe that the variable cost is only the true manufacturing cost. So likewise, they will treat the variable manufacturing overhead cost as the part of the product cost as well. So the discussion is, what should be your product cost? Should this product cost include the fixed manufacturing overhead piece or not? One method says that it should be, the other method says that it doesn't make sense to do so. So variable costing, guys, will purely see the product cost as the variable pieces. All the variable cost is the product cost because they are avoidable. These guys never want the fixed MOH to be part of the product cost. That means they would treat this as period cost. Fixed manufacturing overhead under the variable method will be expensed in the period. On the other side, your absorption costing method will treat all of the manufacturing cost as the product cost, regardless of whether it was fixed or variable. So if it's manufacturing overhead, it will be treated as part of the product cost. So they allocate the fixed manufacturing overhead to each unit of product. So fixed MOH is then deferred to inventory. Selling and administrative expenses are treated as period cost under this method. Okay, now absorption costing method is harder to interpret because your cost includes the fixed MOH piece. Your operating income is affected by both the revenue as well as production. Now, the absorption method is widely used for internal and external reporting purposes, and it is required for external reporting purposes in United States. The variable method, though, is easier to follow, and in that case, the revenue drives your operating income. This is permitted in Canada for income tax purposes. Okay, now because of how these two methods are different, if you think about this, with the managers, there is always a pressure to create short-term profits. So the managers are strongly tempted to build the inventory without increasing the sales. Okay, so under the absorption method, what the managers technically could do in order to increase the profit is to bump up production, but the sales haven't changed. And in absorption costing, because the fixed cost does get deferred to your inventory at the time it is produced, it will give you better operating income. So the absorption costing is widely used. But the variable costing is preferred by some managers for internal decision makings because these managers believe that truly the avoidable cost is only the variable cost. When we are preparing our contribution format income statement that we had looked at in the earlier chapters with the 3-column format, that has to use the variable costing method. Because remember, with the contribution format income statement, we had shown our expenses in the variable and the fixed categories separately. So if we are using the contribution format income statement method, then it has to follow the variable costing method. So ordinarily then, depending on what absorption method the company goes with, whether they go with absorption or the variable costing, their operating incomes are going to be different amongst these two methods. So the steps that we follow in this case is to calculate our per unit product cost for current as well as preceding periods under both of these methods, the variable cost as well as your absorption cost. Then we will calculate the beginning and ending inventories in units for the current period. Step 3 is to prepare our income statement under absorption method. Then we will prepare our income statement under variable method. And finally, reconcile the operating income under variable costing and absorption costing. So when we are calculating the per unit product cost, the direct material and direct labor is always part of the product. Nobody is disputing this. Same idea applies to your variable manufacturing overhead as well. So direct material, direct labor, and variable manufacturing overhead is always product cost. Nobody is disputing that. The dispute is with regards to your fixed manufacturing overhead and how that should be treated, whether it should be part of the product or not. So if we look under the variable costing method, the direct material plus direct labor plus the per unit variable manufacturing overhead will give us variable cost per unit. In that variable cost per unit, if we add the fixed manufacturing overhead for every unit, so the total manufacturing overhead divided by the number of units produced will give you the per unit fixed MOH rate. So that on top of the variable cost will give us the total absorption cost. So both of the methods agree that direct material, direct labor, and variable manufacturing overhead should be part of the product cost. The dispute is with regards to fixed manufacturing overhead and how that should be treated. And that is the reason for difference in your operating income under the variable and absorption method. So when we are calculating the inventory in units, your beginning inventory is your ending inventory from the preceding month or from the preceding period. In that, we add the new number of units that were produced in the current period. If we deduct the number of units that have been sold in the period, then the resulting difference is your ending inventory in units. Under the absorption costing, if we look at the traditional income statement format, then it's sales minus our cost of goods sold gives you your gross margin. Out of that gross margin, if we deduct our total operating expenses, then we have resulting difference as your operating income or loss. So this is what our absorption costing income statement looks like. Title to the financial statement, name of the business, name of the financial statement, and the period it represents. We start with sales, and cost of goods sold is explained starting with your beginning finished goods inventory. Then we add your cost of goods manufactured, That gives you your total cost of goods available for sale minus your ending finished goods inventory. The resulting difference is your cost of goods sold. So your sales minus cost of goods sold gives you your gross margin. Out of that gross margin, we deduct all of our operating expenses, and under the absorption view, we see all of the selling and administrative expenses as the period cost. Whether they are fixed or variable, we don't care under the absorption method. Selling and administrative expenses are seen as period cost, they are expensed. So once we deduct our total operating income from your gross margin, then the resulting difference is your operating income. Now this format is something that we have seen when we were working on chapter 5. Looking at our income statement under the variable costing, so the contribution format was your sales minus your variable cost gives you your contribution margin. Then we deduct our fixed expenses. That gives you your operating income. And we have seen this format in our contribution format income statement in the earlier chapter as well. So this is what our variable costing income statement will look like. So the same title, name of the business, name of the financial statement, and the period it represents. We're starting with sales, but our expenses are broken down into two sections. The top half is your variable cost and the bottom half is your fixed cost. So with your variable cost, we are starting with the explanation of our variable cost of goods sold, which is your beginning finished goods inventory, plus your cost of goods manufactured, gives you your total cost of goods available for sale. Out of that, if we deduct our ending finished goods inventory, then we have variable cost of goods sold. But here we will add our variable selling and administrative expense. So we are accounting for all of our variable cost here. So that gives you your total variable cost. So the total variable cost deducted out of your sales revenue, the resulting difference is your contribution margin. Out of that contribution margin, we will deduct our fixed cost, which is your fixed manufacturing overhead, which under the variable costing view is seen as period cost. So your fixed cost is your fixed manufacturing overhead as well as your fixed selling and administrative expenses that are deducted to give you the resulting difference of operating income or loss. So here, your variable cost is made up of your variable selling and administrative expenses and your variable cost of goods sold. Your fixed cost is made up of your fixed cost is made up of your fixed manufacturing overhead and your fixed selling and administrative expenses. So all variable costs are seen as are represented in the variables section. So once we prepare our income statement under the absorption costing and our variable costing method, then the operating income under both of these assumptions will be different. So we are looking at reconciling those differences. So your operating income under absorption cost will differ from that under the variable cost, unless the number of units that were produced in the period were exactly the same as number of units sold. Why is that? Because the fixed MOH cost that is deferred in inventory under the absorption costing. All right, so if the number of units manufactured is exactly the same number of units that you sold, then under both of these methods, your operating income will exactly be the same. But if your number of units produced is higher than the number of units the company is selling, then the operating income will be better under absorption costing method and lower under variable costing because your fixed manufacturing overhead piece is deferred to your ending inventory. So this is where the managers can play with the numbers to create the impression that the business is making more money without actually increasing the sales. All we have to do here is bump up the production. The manufacturing overhead cost will be deferred to inventory on our balance sheet or statement of financial position, and our operating income will be higher under the absorption method. But if our production is lower than the sales, then your operating income will be better under variable costing method. So when we are looking at the difference in operating income under both of these methods, when we are trying to reconcile that, the difference has to do with the fixed manufacturing overhead piece. So we look at our variable costing operating income. So the operating income coming from your variable costing income statement. Then we adjust for our ending inventory movement. So we will add the fixed manufacturing overhead that was deferred to ending inventory under absorption method, and we will deduct the fixed manufacturing overhead that was released from beginning inventory under absorption costing. So the absorption costing operating income has to be the change above. So variable costing operating income plus the deferred MOH piece minus the released fixed MOH piece that was released from beginning inventory. That number has to be the same as your operating income under absorption costing. So with this chapter, we will be discussing this in class example 1 in class as well as in class problem 2, and see if we will have time to cover any more examples. Thank you for listening in. This is all I have for chapter 8.